Debt market update, July 2022. The G-Sec yield curve continued to flatten in July 2022 as yields at short end rose between 5 to 25 basis points, whereas 10-year G-Sec yields edged lower. The 10-year G-Sec yield ended the month at 7.32%, 13 basis points lower than last month. The decline in commodity prices, especially energy prices, fall in US yields, rising global growth concerns, dovish commentary by US Fed, etc., were the key drivers of movement in yields. Corporate bond spreads over G-Sec narrowed on back of lower corporate bond supply. Average net interbank liquidity declined sharply month on month, driven by US dollar selling by RBI and increase in currency in circulation. Further, the credit growth outpaced deposit growth during the month. FPI sold net debt, including voluntary retention route, worth $0.4 billion in July 2022, as against net outflows of $0.2 billion in June 2022. Cumulatively, FPIs have sold debt worth $0.9 billion in 4 months FY23, vis-a-vis net buyer of $0.2 billion during the same period last year. MPC in its meeting concluded on August 5, 2022, unanimously voted in favor of raising the policy repo rate by 50 basis points to 5.4%. MPC also maintained that it remains focused on withdrawal of accommodation to ensure that inflation remains within the target going forward, while supporting growth. Outlook: the increase in repo rate was at higher end of market expectation range. Further, RBI governor mentioned that resilience of domestic economy provides RBI the space to act on inflation. Consequently, yields rose by 10 to 15 basis points across the curve. Cumulatively, MPC has raised repo rates by 140 basis points since May 2022 and is now above the pre-pandemic level of 5.15%. The commentary by RBI governor in his speech and press conferences hinted that the monetary policy is likely to remain calibrated, measured, and nimble, keeping in mind the evolving economic situation. Further, it mentioned that it remains committed to bring down inflation close to target of 4% over the medium term and will take steps to control inflation and manage inflation expectations. Thus, we believe that RBI is likely to act in a balanced manner going forward, but will remain data dependent. Going forward, elevated energy prices, resilient CPI and WPI, accelerated tightening by major global central banks, etc., are likely to put upward pressure on yields. Further, supply of state development loans, which have been muted until now, is likely to pick up in ensuing quarters. This can put further upward pressure on yields given the high SLR holdings of banks and robust credit demand. However, over the past couple of months, several factors supporting lower yields have emerged, and yields have corrected from the recent highs. These include rising global growth concerns, decline in US yields, and broad-based correction in international commodity prices from their peak. Risk of fiscal slippage by center has also reduced, given the better tax collections and recently announced measures to impose windfall tax on export of oil and select petroleum products. Negative balance of payment in FY23 should drain the system liquidity and could open up space for conducting OMO purchases by RBI in the second half. On an overall basis, given the counterbalancing forces at play, yields are likely to trade in a range with a slight upward bias in our view. However, it is not likely to breach the recent highs unless oil prices rise significantly. In view of the above, we recommend staggered investments into short to medium duration debt funds, with some allocation to longer duration debt funds in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.